Welcome back to the Deep Dive, where we dig into those dense financial guides you've been meaning to read and pull out the most actionable knowledge you can use right away.
Today, we are zeroing in on the Canadian tax system. And, our goal is maybe a bit radical.
Okay, I'm listening.
We want you to stop seeing your taxes as just this annual chore you have to get through.
The compliance burden.
Exactly. And start treating the system as what it actually is. An essential, integrated tool for making strategic financial decisions and, for actually building wealth.
That really is the core idea in the source material we're using today. This high-level financial planning stuff. It makes it so clear that taxation isn't some separate thing you think about in April.
No, it's integral.
It's part of every single financial decision you make. Every choice about investing, spending, saving, borrowing, it all comes down to one thing: maximizing your after-tax cash flows.
And if you ignore that, if you ignore the tax implications of a product or a strategy, you're almost guaranteeing a less than optimal outcome.
You could be making the right investment, but just structuring it all wrong.
That's it. Exactly.
Okay, let's unpack this. Our mission today is, it's more than just surviving tax season. We want to give you the sophistication to look at any financial product, whether it's a GIC or an RRSP contribution, and instantly understand its true after-tax value. And this gets to the key goal our sources kept hammering home. Sound financial planning is about maximizing your household's net worth and your after-tax income. It is not just about minimizing tax.
That distinction is so important, and it's where a lot of people stumble.
How so?
Well, if you only chase tax minimization, it can lead to some really destructive financial choices.
Right, like those high-risk, low-liquidity investments you sometimes hear about.
Exactly. Or tax shelters with huge fees that only promise tax relief. I mean, if the investment itself has a terrible return, who cares if you saved a bit of tax on it? You're not building wealth.
So we have to focus on the bottom line. What you actually get to keep.
What you keep and what your net household worth actually is. That's the game.
So before we get into the strategies, let's just quickly set the stage.
Yeah.
Where does the Canadian government even get all this tax revenue from?
It's pretty standard, really. Canada has three basic sources. The first is income tax, which is our main focus today.
Yeah.
Then you have consumption taxes. So that's your GST and HST that you pay on goods and services. And finally, wealth taxes.
Which for most people just means property tax.
Right. That's right. It's primarily municipal property taxes, which are based on the value of your assets, like your home.
And you mentioned earlier, the system isn't just about raising money for the government.
Yeah.
It has these broader objectives.
Absolutely. Beyond just, funding public projects and social programs, the system has two other really crucial jobs.
Okay.
First, it's a massive engine for redistributing income.
Through the progressive tax rates.
Yes, through progressive rates, so higher earners pay a higher percentage, and also through all the tax credits that are designed to support lower and middle income families.
And the third goal,
Yeah,
that's the one we're really interested in today as planners.
that's the one. It's providing incentives and disincentives. So for example, the government gives you a tax deduction for contributing to an RRSP. That's a huge incentive to save for your own retirement.
And on the flip side.
On the flip side, you have high taxes on things like tobacco or gasoline, which act as a disincentive for consumption.
I really like the analogy in our sources for why tax knowledge is so critical. It compared the financial planner to a pharmacist.
It's a great analogy. As a financial advisor, you don't need to be the tax lawyer who writes the rules, but you have to be sophisticated enough to understand the tax features of financial products and, crucially, what happens when you combine them.
Right.
Just like a pharmacist needs to know every single drug a patient is taking to avoid a dangerous interaction, you need to know your own tax profile, your marginal rate, your deductions, your credits, to make sure that the financial products you choose don't, interact in a bad way and undermine your whole financial plan.
That sets the stage perfectly. So let's get into it. The Canadian system, it's complex. It can be frustrating with all its different rates based on time and who the taxpayer is and what they're doing. But that complexity is actually where the opportunity lies.
That's it. We're looking to legally use those different rates to our advantage. The sources boil effective tax planning down to two fundamental things: trading across tax rates and using the time value of money.
Which brings us to our core strategies: income deferral and income splitting.
Yeah.
Let's start with deferral. It sounds simple enough, just delay paying your tax. But what does that really mean for maximizing wealth? It's more than just pushing a payment down the road, isn't it?
It is. The benefit of income deferral is really threefold. First, you're trying to delay recognizing that income until a time when your marginal tax rate, or MTR, is lower.
Okay, that makes sense.
And second, and this is the really powerful part, you are earning compound returns on the full pre-tax amount of your money, not the smaller after-tax amount.
Right, so if I earn, say, $10,000 today, and I'm in a 40% tax bracket, I only have $6,000 left to invest.
Exactly.
But if I can defer that income into a registered account, like an RRSP,
You get to invest the whole $10,000. That extra $4,000 is working for you, generating returns right from day one. Over 20 or 30 years, that compounding difference is just staggering.
even if I end up paying the same tax rate when I take it out later.
Even then. Now, our sources lay out two key scenarios. The first is, what if your tax rate is expected to stay the same your whole life?
So you're always in that 40% bracket.
Right. Even then, deferral is still better, purely because of the time value of money. You're delaying the payment. The classic example is unrealized capital gains on stocks in a regular investment account. You don't pay tax on the growth until you sell, so the full amount keeps compounding.
But the real magic happens when your tax rates are expected to go down.
That's the second scenario, and it's the most common one. As you get closer to retirement, your employment income usually stops, you start drawing down your assets, and your marginal tax rate often drops substantially.
So you get a double win.
You do. You get the benefit of compounding on that bigger gross amount, and you end up paying less tax overall when you finally take the money out.
And the government has a whole alphabet soup of accounts to help us do this.
Because you've got CPP and QPP, employer pension plans, or RPPs, the big one for most people, the RRSP.
Which later turns into a RRIF.
RRIF, right. And then more specialized things like LIRAs and DPSPs.
The RRSP is obviously the centerpiece for most Canadians.
Hmm.
But I think it's still misunderstood. People get hung up on the fact that withdrawals are fully taxable. They see it as a wash, tax now versus tax later.
And that perspective just completely misses the point. Yes, withdrawals are taxable, but your total tax bill is usually much lower because of those two things we mentioned.
The immediate deduction.
Right, you get an immediate tax deduction when you contribute, which saves you tax right now at your highest marginal rate. If you're in a 40% bracket, a $10,000 contribution instantly cuts your tax bill by $4,000.
And the second part is the compounding.
It's that power of compounding on the gross amount. Let's make that really simple. Imagine a 40% taxpayer. They can either invest $10,000 pre-tax in an RRSP earning 8%, or they can invest $6,000 after tax in a regular account also earning 8%.
Okay.
After 1 year, that non-registered account grows by 8% of $6,000, which is $480. Then that interest gets taxed, leaving you with maybe $288 of actual growth.
But the RSP.
The RRSP grows by 8% of the full $10,000. That's $800. And that entire $800 gets reinvested, tax-free, which just accelerates the growth even more. Even when you pull it out later and pay tax, you'll end up with way more money.
And the sources pointed out that even when you contribute during the year, makes a difference.
A huge difference. Everyone knows about the first 60 days rule, where you contribute in January or February for the previous tax year. But the smart move is to contribute at the very beginning of the tax year, say on January 1st.
Instead of waiting until the deadline the following March.
Exactly. That way, your money starts earning those tax-sheltered returns a full 14 or 15 months sooner. Over a lifetime, that extra compounding period really adds up.
Let's use that great working example from the material with Grace Moloko and her planner, Brian. It shows how simple this can be.
It's a perfect example. Grace is an account manager, and she gets a $10,000 bonus every year in December. Her planner, Brian, knows that she's planning to take a 6-month unpaid leave of absence starting in April of next year.
Which means her income next year is going to be way lower.
Substantially lower. And that will push her down into a lower marginal tax bracket.
So if she gets the bonus in December of this year, it's just stacked on top of her full salary and gets taxed at her high MTR, maybe 43%. She loses $4,300 right off the top.
But Brian gives her some simple advice. He tells her to ask her employer to just delay paying the bonus from December 15th to January 5th.
It's only a 3-week delay.
That's all. But because she receives it in the new year, it's reported in that subsequent tax year. And because she's on leave for 6 months, her MTR in that year might only be, say, 30%.
So instead of paying 43% tax on that bonus, she pays 30%. That's a $1,300 saving just by shifting the payment date.
That's trading over time in action. It's using the tax calendar as a lever. It shows why you absolutely have to know what your marginal tax rate is going to be in the future.
And conversely, if you think tax rates are going to go up,
Then the whole incentive flips, doesn't it? If you're worried about huge government deficits or new political policies, then you'd want to accelerate your income, realize bonuses early, maybe sell some assets, and pay the tax now at a lower known rate rather than later at a potentially much higher unknown rate.
that moves us perfectly into the second big strategy, income splitting, or trading across taxpayers. This is all about using the progressive tax system to the household's advantage.
Exactly. We define income splitting as legally shifting income from a taxpayer in a high bracket, usually the main earner over to a spouse or a child who's in a lower bracket. The goal is to lower the total tax bill for the entire family.
And this is most useful for couples where there's a big difference in income.
A big income disparity, or for older households that have already built up a lot of assets.
The simplest strategy mentioned in the sources doesn't even involve any special accounts. It's just a household cash flow decision.
It's so simple but so effective. The high-income spouse just pays for all the household bills, the mortgage, the groceries, the utilities, the car payments, everything.
And what does that do?
It frees up the entire income of the low-income spouse. They can then take their own money and accumulate and invest it in their own name. And because it's their own income, all the future investment returns are taxed at their lower marginal rate. No attribution rules triggered.
Okay, so let's get into the more formal tools. The spousal RRSP is probably the most common one for couples.
It's a fantastic tool because it gives the household an immediate tax deduction at the highest possible rate.
So the higher income spouse makes the contribution.
They make the contribution, they get the tax deduction right now at their high MTR, say 45%. But the RRSP account itself is registered in the lower income spouse's name.
So the money grows tax sheltered, and then when it's taken out in retirement.
It's taxed in the hands of the low income spouse at their hopefully much lower retirement MTR, maybe 25%. It's a double win. High rate deduction now, low rate tax later.
But this is where the CRA put in a big roadblock, the attribution rules.
Yes, the government is wise to this, and they stop you from doing a quick in and out. The attribution rule says that if any money is withdrawn from that spousal RRSP in the same year it was contributed or in the next 2 calendar years,
The withdrawal gets taxed back to the person who put the money in.
it gets attributed back and taxed to the high-income spouse, completely defeating the purpose.
Can you just clarify the timing on that? It's often a point of confusion.
Sure. Let's say the high-income spouse contributes in, say, December of 2025. The restricted period is all of 2025, plus the 2 full calendar years after that, 2026 and 2027.
So the earliest the money can come out without attribution is January 1st, 2028.
That's right. You need to let that full period pass before you can realize the tax benefit.
That brings us to the general attribution rules for just giving assets to a spouse, which are even stricter. What happens if the high-income spouse just gives a portfolio of stocks to the low-income spouse?
In general, if spouse A gives assets to spouse B, any of the investment income that comes from those assets, the interest, the dividends, the capital gains, it all gets attributed back to spouse A and taxed at their higher rate.
So you can't just shuffle ownership around.
Not directly, but the source material points out a really important loophole that the CRA allows. It's called second-generation income.
And this is key for long-term planning.
It's absolutely critical. So the first-generation income, the returns on the assets you originally transferred, that gets attributed back. But the income that the receiving spouse earns by reinvesting that first-generation income.
That's not subject to attribution.
That's right. It's taxed in their hands.
So let's use the example from the text with Jerome and Ruth. Jerome is the high earner. He gives some high dividend stock to Ruth, the low earner.
Okay. So Ruth gets, say, $2,800 in dividends. That's first-generation income.
So that gets taxed back to Jerome.
Correct. But Ruth immediately takes that $2,800 and she buys a new investment with it. That new investment earns, say, $168 in interest. That's second-generation income.
And because Ruth has very little other income, that $168 is taxed at her very low rate, maybe even zero.
Exactly. And now she's started building a portfolio in her own name that is completely free from any future attribution. It's a slow and steady strategy, but it works over time.
But what if you need to shift assets more quickly?
Then you can structure the transfer as a formal loan, as long as it has an interest rate at or above the CRA's prescribed rate.
What exactly is this prescribed interest rate?
It's a minimum interest rate that the CRA sets every quarter. It's based on the yield of government treasury bills. Its purpose is to make sure any loan used for tax planning is a real, legitimate loan.
So it has to be a bona fide transaction.
It does. The interest has to be charged, and it has to be paid, but the rate is usually quite low, often just 1 or 2%.
And what's the tax advantage of doing it this way?
The borrowing spouse can deduct the interest they pay on the loan as long as they use the money to buy an income-producing investment.
Okay.
And the lending spouse has to include that same interest as income. So it's a very structured but very effective way to shift income from the high-income spouse to the low-income spouse right away. Hashtag tag tag quidizai. Splitting income with children. Specific rules.
Okay, shifting income to children, that's a whole other ballgame, isn't it? The attribution rules get even tighter.
They get very tight. The government really wants to prevent parents from just using their kids' low tax brackets as personal tax shelters, unless it's specifically for something like education.
So if I just give money or assets to my child who's under 18,
Any of the interest income or dividend income that's generated from that gift gets attributed right back to you, the parent.
but there is one huge exception, and this basically defines the whole strategy for investing for minors.
That's right. The exception is capital gains. The CRA has always ruled that any capital gains realized on assets that were gifted to a minor child are taxed in the child's hands.
And that's the key. That's the lever you can pull.
It is. Now, once the child turns 18, things change dramatically. The attribution rules mostly disappear. And that second-generation income rule we talked about for spouses, that also applies to minors.
So let's run through the specific acceptable strategies for children. There was one that I found really interesting, using the Canada Child Benefit, the CCB.
Yes, the CCB payments are a great starting point because they are not taxable income to the parents.
So it's clean money from a tax perspective.
It is. So if parents take those CCB payments and put them into a separate designated bank account for their child, held in trust, any interest that's earned on that money accumulates in the child's name.
And since the child has no other income, that interest is effectively tax-free.
Almost certainly tax-free because it will be well below the basic personal amount, which is over $15,000 now. It's a really clean way to build up some long-term savings for education or other goals.
Then, of course, there's the main vehicle for education savings, the RESP, the Registered Education Savings Plan.
The RESP is a beautiful thing. The contributions you make are with after-tax dollars, so there's no deduction. But the money grows completely tax-free inside the plan.
And the real benefit comes when the money is taken out.
That's right. When the student withdraws the money for education, it's only the growth portion and the government grants that are taxable.
And why is that so good?
Because it's taxed to the student. And a student is, again, almost always in the lowest possible tax bracket. They can usually pull out thousands of dollars completely tax-free. And on top of that, you get the Canada Education Savings Grant from the government, which is just free money.
Okay, finally, let's go back to that growth stock strategy, the one that uses the capital gains exception for minors.
This is a very effective strategy, but it does come with some risk. The parents use their own after-tax money to buy stocks with good long-term growth potential, and they buy them directly in the child's name.
And because capital gains aren't attributed back to the parent.
When the child eventually sells those shares, maybe 15 years down the road, only 50% of the gain is taxable, and it's taxed at the child's low or zero MTR.
But the risk you mentioned is about control.
It is. Unlike an RESP where the money has to be used for education, these funds are the child's property. Once they turn 18, they have complete control. They can sell the whole portfolio and, buy a sports car if they want.
So it requires a lot of trust.
It demands a huge amount of trust and a very long-term view of your family relationship. But the tax savings, avoiding capital gains tax at the parent's high rate, can be absolutely massive.
We've covered the core strategies of deferral and splitting. Now let's get into the mechanics. Part 2. The Canadian tax calculation journey. And here's where it gets really interesting, because we're going to break down the T1 general tax form and show you why every single line matters.
Understanding the flow, from your total income all the way down to your net federal tax, that is the bedrock of tax planning. If you don't know the structure, you can't optimize it. And remember, the deadline for this is usually April 30th. Hashtag tag tag AAI. From total income to taxable income.
Okay, let's break down the calculation, and let's keep emphasizing that key difference. A deduction saves you money at your highest tax rate, but a credit only saves you money at the lowest rate.
Step 1 is calculating your total income. This is just adding everything up. Your wages, salary, any business income, your investment income, so that's 100% of your interest and rent, and your dividends, And then only the taxable portion of your capital gains.
Which is 50% of the gain.
50%. So you add all that up to get total income. Then, step 2, from that total income, you subtract your allowable deductions to get to your net income.
And what are those deductions?
These are things like your RRSP and RPP contributions, any union dues you pay, childcare expenses, things like that. And net income is a really important number.
Why is that?
Because that's the figure the government uses to determine if you're eligible for a lot of income-tested benefits, like the Canada Child Benefit or Old Age Security. So a lower net income can often mean more government benefits.
Okay, so that's net income. Then what's step 3?
From net income, you subtract a few additional deductions to get to your taxable income.
And these are more specific things.
Very specific. Things like carrying forward losses from previous years or certain stock option deductions, and the big one for business owners, the lifetime capital gains exemption. So after all that, you have your taxable income. And that is the number that the tax brackets are actually applied to.
So once we have that taxable income figure, we apply the progressive federal tax rates. For 2025, that starts at 15%, that goes up to 20.5%, 26%, 29%, and finally 33% for the highest earners.
And that gives you your initial federal tax liability. The very last step to get to your net federal tax amount is to subtract the value of all your non-refundable tax credits.
Okay, let's run our example taxpayer Ralph through this process. Ralph earned $80,000 and he made a $5,000 RRSP contribution.
So Ralph's total income is $80,000. He uses his $5,000 RRSP contribution as an allowable deduction.
Which brings his net income down to $75,000.
Right, and if he has no other deductions, his taxable income is also $75,000.
Okay, so let's apply the 2025 federal brackets to that $75,000. The first $57,375 is taxed at 15%. That works out to $8,606.25.
Right. And then the rest of his income, which is $17,625, that falls into the second federal bracket.
And that's taxed at 20.5%.
It is, which comes to another $3,613.13 in tax.
So if we add those two together, Ralph's federal tax bill before any credits is $12,219.38.
And we can't forget the provinces.
Yeah.
They add their own layer of tax on top of that. They use the same federal taxable income number, but they have their own rates and their own credits.
Right. And for Ralph in Ontario, his provincial tax was another $4,694.
So his total initial tax bill is almost $17,000. Then his credits get applied to bring that down. But you have to do the calculation in that exact order.
Okay, this might be the single most important concept for anyone trying to do strategic planning. If you only remember one number from today, it should be your marginal tax rate. Let's really clearly define the difference between that and your average rate.
The average tax rate is, it's a backward-looking number. It's just your total tax paid divided by your total taxable income. For Ralph, his average rate was about 18.27%. It's interesting to know, but it's totally useless for making future decisions.
What's fascinating here is how different the marginal tax rate is. It's all about looking forward. Why is it so much more important?
Because the MTR is the tax you pay on your last dollar of income. Or, more importantly, it's the combined federal and provincial rate that applies to every additional dollar you earn or every dollar you deduct.
So it tells you the real cost of a bonus or the real savings from an RRSP contribution.
Exactly. It drives all of those decisions.
Okay, so let's calculate Ralph's NTR. His $75,000 income puts him in the 20.5% federal bracket.
Correct. So if Ralph earns $1,000 more, that extra $1,000 is taxed at the federal rate of 20.5%, plus the Ontario provincial rate, which is 9.15%.
So his combined marginal tax rate is 29.65%.
That's right. For every extra dollar he earns, he loses almost 30 cents to tax.
And that 29.65% MTR is way higher than his 18.27% average rate. This is where the knowledge becomes power. Let's go back to that example of Isaac Sinclair in his $5,000 bonus.
Okay, so Isaac's planner knows his MTR is 30%. If Isaac just takes that $5,000 bonus and puts it in the bank,
the government immediately takes $1,500 in tax, 30% of $5,000. He only gets to keep $3,500.
Exactly. But if Isaac is smart and he puts the full gross $5,000 directly into his RRSP,
He gets a $5,000 deduction.
which completely offsets the $5,000 bonus, he avoids paying that 30% on TR tax entirely, and he's turned a $3,500 after-tax decision into a $5,000 tax-sheltered investment.
The MTR is what tells you the exact dollar value of any deduction.
It's the engine of the tax savings. For Ralph, that $5,000 RSP deduction saved him exactly 29.65% of $5,000, which is $1,482.50. That's the precision you need for good planning. The average rate is interesting history. The marginal rate is your tool.
Okay, the journey gets even more complex from here because not all money is treated the same way by the CRA. We have to dive into the four main categories of income: employment, business, investment, and capital gains, because how your income is classified has a massive impact on your after-tax wealth.
So employment income is your salary, wages, bonuses, commissions. And the key rule here, as we talked about with Grace, is the timing. It's reported in the year it's received, not the year it was earned.
And beyond just salary, we have to talk about fringe benefits. The general rule seems to be if your employer pays for something that's really a personal living cost, it's probably a taxable benefit.
That's a great rule of thumb. Think about rent-free housing or a private gym membership. Taxable benefits also include things like non-cash gifts over $500 or a holiday trip unless it was absolutely for business.
What about things like employee loans?
Yes, if your employer gives you a low-interest loan, there's a taxable benefit calculated on the difference between the interest you pay and the CRA's prescribed rate.
But the most complicated benefit, the one that requires the most tracking, has to be the automobile benefit for personal use of a company car. It's got two parts.
It does. The first part is the standby charge. This is a calculated cost for just having the vehicle available for your personal use, even if you don't drive it much, and it's based on a percentage of the original cost of the car.
This can be a real killer, can't it? Especially with older, more expensive cars.
Absolutely. Because the standby charge is based on the original cost, that tax hit doesn't go down as the car gets older. But you can get a reduced standby charge if you use the car more than 50% for work and keep your personal kilometers below a certain limit.
Which means you have to track everything meticulously.
You have to. Which brings us to the second part, the operating cost benefit.
And this covers gas, insurance, maintenance.
All the running costs that the employer pays for your personal use. You can calculate this in one of two ways. Either a set rate per kilometer of personal driving, or if you use the car mostly for work, you can just calculate it as 50% of the standby charge.
And you should always calculate it both ways.
Always. And choose whichever one results in a lower taxable benefit. The simple advice here is if you drive a lot for personal reasons, you're probably better off owning the car yourself.
On the other hand, you should be actively negotiating for non-taxable benefits.
Yes. These are perks that are explicitly tax-free, and they can be way more valuable than a simple salary increase.
So what are the big ones we should be asking for?
The biggest one is employer contributions to a registered pension plan, an RPP. Those are not a taxable benefit to you. Also, premiums for private health and dental plans, group disability insurance, counseling services for mental or physical health, and even professional dues if they benefit the employer. #B, business income and capital cost allowance, CCA. Okay, on to business income. This is basically profit from any activity that you carry on with the intention of making a profit. It doesn't matter if you're a sole proprietor, a partnership, or a corporation.
And the big hurdle for anyone trying to claim a business loss is that reasonable expectation of profit or REOP test.
Right. The CRA will deny your losses if they think your business is really just a hobby. They look at things like, have you invested real time and money? Do you have a business plan? Are you running it in a business-like way?
So my hobby farm that loses money every year might get questioned.
It might. Another key difference for businesses is that you have to use the accrual method of accounting, not the cash method.
So you report revenue when you earn it, not when you get paid.
Exactly. You report revenue when you send the invoice, and you claim expenses when you receive the bill. This stops people from playing games with timing payments across year-end to defer tax.
Let's talk about the most complex business deduction. Capital cost allowance, or CCA. That's the tax version of depreciation.
It is. CCA is an annual deduction you can claim for the wear and tear on your business assets, like equipment, furniture, cars. Each year you claim CCA, it reduces the book value of the asset for tax purposes, which is called the undepreciated capital cost, or UCC.
And we can't forget the half-year rule.
The half-year rule. In the year you buy an asset, you can only claim 50% of the normal CCA rate. This stops someone from buying $1 million worth of equipment on December 30th just to get a massive tax deduction for that year.
Okay, so what happens when you sell the asset? This is where we get those two very different outcomes. Recapture and terminal loss.
Right. Recapture happens if you sell the asset for more than its remaining UCC balance. It basically means you claimed too much CCA in past years.
So you have to pay it back.
You do. That difference, the recapture, is added back to your income and is fully taxable as business income.
But the opposite of that, a terminal loss, is actually really good for the taxpayer.
A terminal loss is fantastic. This happens when you sell the last asset in a class and there's still a positive UCC balance left over. It means you didn't claim enough CCA over the years.
So you get to deduct that remaining amount.
You get to deduct that entire remaining UCC balance as a terminal loss. And because it's a business loss, you can deduct it against any other source of income you have, like your salary. It can be a very powerful planning tool, ####she, investment income versus capital gains.
Okay, this is the big one for most of our listeners who are trying to build wealth. How your investment returns are characterized makes a huge difference to your bottom line.
Let's start with the least tax-efficient type of income, interest income. Interest from bank accounts, GICs, bonds. It is 100% taxable at your marginal rate. If your MTR is 45%, that 4% GIC is only really earning you 2.2% after tax.
And there's that accrual rule for interest that catches a lot of people by surprise.
It does. Even if you have a 5-year GIC that only pays out the interest at the very end, you still have to report the interest that has accrued each year on the anniversary date of the investment. You're paying tax on money you haven't even received yet.
Which makes those kinds of products not great for a non-registered account.
It's not for a high-income earner, no. Next up, we have dividends from Canadian corporations, which get much better tax treatment because of something called the integration system.
And the goal of this system is to prevent double taxation, right?
Exactly. The idea is that the income was already taxed once inside the corporation, so you shouldn't get fully taxed on it again.
So how does it work?
It's a two-step process. First, the dividend you receive is grossed up, which means it's artificially increased on paper to represent the pre-tax corporate earnings. That grossed up amount is added to your income.
And then?
Then, after you calculate the tax on that larger amount, you get to claim a dividend tax credit, which gives you credit for the tax the corporation was assumed to have already paid.
And the net result?
The net result is that eligible Canadian dividends are taxed at a much, much lower rate than interest income. It makes Canadian stocks very tax efficient.
And finally, the most tax-friendly category of all, capital gains.
Capital gains come from selling a capital asset, stocks, mutual funds, real estate for a profit. And the single biggest advantage is that only 50% of the gain is taxable.
So a $10,000 profit only adds $5,000 to your taxable income.
Right. If your MTR is 40%, your effective tax rate on that capital gain is only 20%. This is why planners will always choose capital gains over interest income.
But this is where you can run into trouble with the CRA, with that adventure in the nature of trade rule.
Yes, this is the CRA's weapon against people who are really running a business but trying to claim their profits as capital gains. If they think your main intention was to make a quick profit, like flipping a condo in 3 months, they can reclassify that entire profit as business income.
And then it's 100% taxable.
100% taxable. So your intent is critical. You need to be able to show that you bought the asset for long-term benefit, not just for a quick resale.
One of the huge benefits of capital gains is that you don't pay tax until you sell. The gains can compound for years, tax-free.
And that allows for strategic timing. You can decide to sell an asset in January instead of December to push the tax bill a full year down the road. But you do have to be aware of the deemed disposition rules.
That's when you change the use of a property, right? Like turning your house into a rental.
Exactly. The CRA treats that as if you sold the property at its fair market value, which can trigger a big capital gain unless you file a special election to defer the tax.
And a final reminder, capital losses can only be used to offset capital gains.
That's a key restriction. Unlike a business loss, you can't use a capital loss to reduce your tax on your salary or interest income. You have to match your gains and losses carefully.
We dissected the different types of income. Now for the final part of our deep dive, let's look at the tools you use to actually reduce your tax bill once everything's been calculated. Part 4, the tax toolkit deductions versus credits.
And just to reiterate that core distinction one more time, a deduction reduces your taxable income, so it saves you tax at your high marginal tax rate. A credit reduces your final tax bill dollar for dollar, but it's calculated at the lowest federal rate, which is 15%.
So for a high-income earner, a deduction is always worth more than a credit of the same amount.
Always. #tag key deductions.
The number one deduction for most Canadians is still the RRSP contribution. It gives you that immediate tax savings at your MTR.
It does. And the key is to know your contribution limit. It's the lesser of 18% of your previous year's earned income, or the annual maximum, and then you have to subtract any pension adjustments from your work pension and add any unused room you've carried forward.
It's a complicated formula, but the CRA tells you your limit on your notice of assessment.
They do. Another valuable deduction, though it's more situational, is moving expenses.
Right, if you move at least 40 kilometers closer to a new job or school.
Correct. And the amount you can deduct is limited to the income you earn at that new location. But if you move late in the year, you can carry forward any unused expenses to the next year, which is a nice feature.
Okay, let's talk about the most important deduction for investors. Carrying charges and interest expenses. This is an area where people make a lot of mistakes.
They do. So any expenses you incur to earn investment income are generally deductible. That includes things like investment counseling fees for your non-registered accounts, but the big one is interest.
The interest deductibility rule is very specific.
It is. You can only deduct interest on a loan if you use that loan to buy an investment that has the potential to produce income, like dividend-paying stocks, bonds, or a rental property.
And what's the biggest mistake people make here?
They try to deduct interest on a personal loan. You can't deduct interest on your mortgage for your principal residence, and you can't deduct interest on a loan you took out to make an RRSP contribution.
Because the RRSP contribution itself is the deduction. You can't double dip.
You can't. This brings us back to that final Grace Maloka example, which perfectly illustrates how to structure your debt to maximize your deductions.
All right. She had $11,000 in cash, and she wanted to put $10,000 into her RRSP and buy $10,000 in shares. So she needed to borrow $9,000.
If she uses her cash for the shares and borrows for the RSP, the interest on that $9,000 loan is not deductible. It's a bad move.
So the smart play is to do a swap.
It's a cash flow swap. She should use $10,000 of her own cash to make the RRSP contribution. She gets the big deduction for that. Then she borrows the $9,000 specifically to buy the shares.
And because that loan is now directly traceable to an income-producing asset.
The interest on that loan is fully tax deductible. She's turned non-deductible debt into deductible debt just by changing how she used her cash.
Beyond interest, there are also loss carryovers and the lifetime capital gains exemption.
Right. Non-capital losses, like a business loss, are very flexible. You can use them to offset any kind of income, and you can carry them back 3 years or forward 10 years.
But capital losses are more restricted.
Much more restricted. They can only be used to offset taxable capital gains. You can carry them back 3 years or forward indefinitely, but only against gains.
And the LCGE, the lifetime capital gains exemption, that's the big prize for entrepreneurs.
It is a massive deduction. For gains on the sale of shares of a qualified small business corporation or a qualified farm or fishing property, the exemption is huge. It's going up to $1.25 million after June 24, 2024. It allows business owners to take a huge chunk of the sale of their business completely tax-free. #B key tax credits.
Okay, moving on to credits, which all give you savings at that flat 15% federal rate. We start with the basic personal amount, which everyone gets.
Right. That ensures that everyone has a base amount of income that is tax-free.
Let's talk about the medical expense tax credit.
Okay.
This one is tricky because you can only claim expenses that are above a certain threshold.
That's right. It's expenses over 3% of your net income, or a set dollar limit, whichever is less. So the planning challenge is getting over that threshold.
And the key planning tip here is that you can choose your own 12-month period.
It's a great feature. You can pick any 12-month period that ends in the tax year. So let's use the Casey example from our notes. He had a big dental bill in November of last year, and then he bought new glasses in February of this year.
If he uses the calendar year, those two expenses might not be enough to get him over the threshold in either year.
Exactly. But if he chooses a 12-month period from November 1st to October 31st, he can group both of those expenses together. That combined total is much more likely to get him over the 3% threshold, allowing him to claim the credit. It's a simple trick that can save hundreds of dollars.
Next up, the Canada Training Credit. This one's newer, and it's refundable.
And that refundable part is key. The CTC is for working Canadians who are upgrading their skills. If you're eligible, you accumulate $250 a year in a notional account, up to a lifetime max of $5,000.
And because it's refundable, it helps, even if you don't have much income.
Right. The credit covers half of your eligible tuition. And if that credit is more than the tax you owe, the government sends you the difference back in cash.
Finally, let's talk about the charitable donation tax credit. It's unique because it has a two-tier rate.
It does. It's designed to encourage larger donations. The first $200 of your annual donations only gets you a 15% credit. But any amount above $200 gets a credit at a much higher rate, up to 33% federally.
So the planning tip for couples is to pool all your donations on one person's tax return.
Absolutely. That way, you only have to get over that low-rate $200 threshold once for the whole family, and the rest of your donations get the much higher credit rate.
But the real power move for charitable giving, the one that every serious investor needs to know about, is donating appreciated capital property.
This is where the planning gets really sophisticated. When you donate something like stocks or land that has gone up in value, you trigger a capital gain. But the tax rules give you some options. You can elect a deemed sale price anywhere between what you paid for it and what it's worth now.
Let's use that Grace Maloka painting example. She bought it for $10,000 and now it's worth $30,000.
Right. If she just sold it, she'd have a $20,000 gain and pay tax on $10,000 of that. But if she donates the painting and elects a sale price of the full $30,000,
She still has that $20,000 gain.
she does. But she also gets a charitable donation receipt for the full $30,000. And the tax savings from that huge donation credit is far more than the tax she has to pay on the capital gain. It's a huge net financial win.
But the biggest power move of all is when you do this with publicly traded stocks because of the zero inclusion rate.
That's the ultimate strategy. When you donate publicly traded stocks or mutual funds directly to a charity, the capital gain you realize has a zero inclusion rate.
Meaning you pay zero tax on the gain.
Zero tax on the gain, but you still get a donation receipt for the full fair market value of the shares. If you have stock worth $100,000 that you bought for $10,000, you save all the tax on that $90,000 gain, and you get a $100,000 tax credit receipt. It is, without a doubt, the most tax-efficient way to be charitable in Canada.
So we've covered a lot of ground. We've navigated the three sources of revenue, the powerful strategies of deferral and splitting, the whole calculation journey from total income to net tax, and that crucial difference between deductions, which save you tax at your MTR, and credits, which give you a flat rate benefit.
I think the main conclusion here is that tax planning isn't something you just hand off to your accountant on April 30th. It has to be an active, ongoing part of your financial life.
You have to be making conscious decisions every day that respect the progressive rates and use the different tax treatments to your advantage.
You have to know your MTR, and you have to apply that knowledge to every single investment decision you make.
So what does this all mean for the bottom line?
It means you have to assess every financial move on an after-tax basis. Think back to Grace Maloka's first problem from her source material. She was thinking about borrowing money at 7% non-deductible interest while she was holding a GIC that was only netting her 2.5% after tax.
She's guaranteeing a loss.
A huge guaranteed loss. And that kind of mistake is only visible, it's only avoidable when you put on the after-tax lens and look at all your financial choices through it.
The characterization and the timing of your income, whether you earn it as a salary, a low-tax dividend, or a 50% taxable capital gain, that can be worth thousands of dollars every single year.
It is, which puts an incredibly high value on your ability to plan ahead. And that leads to our final thought for you to take away. If you could perfectly control your marginal tax rate, if you could delay income to your low-rate years and accelerate deductions into your high-rate years, how dramatically would that single ability change your yearly investment and income planning strategy? Because that knowledge and acting on it is the foundation of maximizing your household's net worth.